Yes, welcome to our corporate accounting class. We are going to continue the yesterday's problem. Yesterday, I solved the problem number 6, taken from Jane and Narang in final accounts of a company. Yesterday, I taught you how to prepare the P&L account. Today, we are going to see that balance sheet, how to prepare the balance sheet. Basically, you are aware about the format for the balance sheet. Previously we had the system of T-shape accounting. One is liabilities, another one side is assets, whereas now we have to prepare it in the form of the statement, that is a schedule 3. Okay, we have to prepare in the form of the statement as per the new schedule 3 of prescribed by company law. We have to prepare it. First part of the balance sheet is equity and liabilities, and on that shareholders funds, then secured loans, unsecured loans, current liabilities. Under current liabilities only we will take unsecured loans. Then another side, another second part of the balance sheet, assets, non-current assets, then current assets we have to take. Let us go one by one. We are given with only the list of informations. From that we have to prepare the balance sheet. First, purchases, wages, manufacturing expenses, salaries, bad debt, director fees, all those items, debenture interest, all those items we have taken already considered for preparing the P&L. Yesterday we prepared the P&L, please mind it. Then call scenario we have. Call scenario where we have to take, already I told you, you are well aware, call scenario should be directed from share capital. Then plant and machinery. For plant and machinery, please have a look on that problem. For plant and machinery, we have the adjustment 10% depreciation we have to provide. So we have taken that plant and machinery under asset side, non-current item 15 lakh minus 10%, balance is 13 lakh 50,000 we have considered. Another one is furniture and fixtures. This is also a non-current item, fixed assets. Then sundry debtor, it is a current item. For sundry debtor, it is coming under trade receivable. And also have a look on that problem. If required, please put a mark on that. For sundry debtors, there is a adjustment given in the question. So that amount of adjustment RBD should be deducted from sundry debtor. Then in this case, it is taken under the heading called subheading called trade receivable. Then another one is general expenses, P&L item, stock, opening stock, P&L item, goodwill. It is taken in asset side of the balance sheet. Okay, so please see that asset side, and on that non-current item you are having asset side of the balance sheet. You are having the goodwill, cash in hand, cash at bank. Both of the items are taken as current assets, that we know very well, but here it should be taken under the subheading called subheading called cash and equivalent item. So that comes to 250 750, 2,50,000 750. Then subscribed and fully paid capital, all sort of capital given in the question should be taken under the heading called schedule number 1, that is for the computation of shareholder fund. Okay, I mentioned only the total heading shareholder fund. Under that, share capital is 20 lakhs. There we have to take from 20 lakhs, we should deduct the calls in arrear. Then another one is surplus. Yeah, I have shown the separate working for that surplus account. What we have to take for the surplus account, we should take what is surplus and the current year profit what we have ascertained in P&L. Then the dividend, any information given like that should be deducted. That comes to 182 500. That should be taken under the heading called schedule number 2, reserves and surplus. Reserve you know very well. Under surplus we have to take this 1,82,500. What the amount of surplus we have ascertained now, that should be taken there. Then debenture is a secured loan, we have considered that. Also put a mark on debenture. There is adjustment for the debenture, provide half year interest on debenture. Already debenture interest is given, that goes to P&L, whereas here that amount of a debenture provision should be made for the debenture interest, that 45,000 is taken here. Then another one is a sundry creditor. You know that sundry creditor is a current item. It is sundry creditor is a current item. It is taken under the heading called current liabilities. Either you can show it as trade payables, account payable as one item, or separate a sundry creditor. Then sales P&L item that already taken. General reserve is schedule number 2, reserves and surplus, or that point A is general reserve 1,25,000. That's all with the given informations. Then you take the adjustments what you are given with the question. Depreciate plant and machinery. Consider fixed assets only for plant and machinery, 10% depreciation provided. Half year's debenture interest, that is also considered, and the amount of debenture interest is added with the amount of debenture, so that we have taken. Then next one is the provision for bad and doubtful debts. From the trade receivables, amount of bad debt is deducted. So you take it as a sundry debtor or the common heading called trade receivable. For strictly speaking, for creditors also, trade payables, under that trade payables, you can take that amount of sundry creditor. Under trade payables, you have to show bills payable, then sundry creditor. Both items should be shown here. But just for understanding purpose only, I have mentioned separate item. Then that's all with this. If you total it, individual schedules, subheadings, total the subheadings, and final total is 42 lakhs 72,500. Both the sides, that is assets and liability sides, are tallied. Okay, so this is an important point. I will send you the question also. This is the important question. In this question, it is easy to prepare that, but you will have to prepare both P&L and balance sheet. Okay, so you please try to understand. Yesterday I sent you the P&L account. Now I have prepared the balance sheet. Okay, this is a format for the balance sheet. Also, you try to understand individually how to prepare the balance sheet based on the new format.